Long-term assets in accounting. Long-term assets, also known as non-current assets, are crucial components of a company's financial statements. These assets are expected to provide economic benefits to a business for more than 1 year and play a significant role in determining a company's financial health and operational capacity. This document explores the key aspects of long-term assets, including their classification, valuation methods, and impact on financial reporting. Classification and types of long-term assets. Long-term assets are typically categorized into several distinct groups, each with its own accounting treatment and financial implications. Understanding these classifications is essential for accurate financial reporting and analysis. Property, plant, and equipment (PPE). Tangible assets used in operations such as buildings, machinery, and vehicles. These assets are subject to depreciation over their useful lives. Intangible assets. Non-physical assets like patents, trademarks, and goodwill. These assets may be amortized depending on their nature and estimated useful life. Long-term investments. Financial assets held for strategic purposes or long-term appreciation, including stocks, bonds, and real estate investments not used in operations. Natural resources. Assets such as oil reserves, mineral deposits, and timber stands. These are subject to depletion as they are extracted or harvested. Each category of long-term assets requires specific accounting treatment and disclosure in financial statements. For instance, PPE is typically reported at historical cost less accumulated depreciation, while intangible assets may be subject to impairment testing. Understanding these nuances is crucial for accurate financial reporting and analysis. Valuation and financial reporting of long-term assets. The valuation and reporting of long-term assets involve complex accounting principles and methodologies. These processes are critical for providing stakeholders with an accurate representation of a company's financial position and performance. Initial recognition. Long-term assets are initially recorded at their acquisition cost, including all expenses necessary to make the asset ready for its intended use. This may include purchase price, transportation costs, installation fees, and any custom duties or non-refundable taxes. Subsequent measurement. After initial recognition, long-term assets are typically measured using either the cost model or the revaluation model. The cost model reports assets at historical cost less accumulated depreciation and impairment losses. The revaluation model allows for periodic revaluation to fair value, with increases typically recognized in other comprehensive income. Impairment testing. Companies must regularly assess long-term assets for impairment. If the carrying amount of an asset exceeds its recoverable amount, an impairment loss must be recognized. This ensures that assets are not overstated on the balance sheet and reflects their true economic value. Financial statement presentation. Long-term assets are reported on the balance sheet under non-current assets. Detailed disclosures in the notes to financial statements provide information on asset composition, depreciation methods, useful lives, and any significant additions or disposals during the reporting period. The valuation and reporting of long-term assets have significant implications for financial ratios such as return on assets and asset turnover, which are used by investors and analysts to assess a company's performance and efficiency. Therefore, accurate and transparent reporting of long-term assets is essential for maintaining stakeholder trust and facilitating informed decision-making. I am AI Jennifer. Thank you for watching. Subscribe to our channel.